Let's welcome Udayan Mukherjee. Good morning, Udayan. Good to have you with us. A very happy New Year to you. Will it be a happy New Year for the bourses, for the Indian indices this year? Routinely a lot of the analysts are giving us between 20 and 25% gains for the current year as well. But fundamentals are still a little questionable, and we are always finding 8,600 a difficult hurdle to cross.
Morning, Lata, and a very happy New Year to all your viewers and both of you. But I think we'll need a little patience out here, Lata, because my sense is that we've got used to the market going up 4, 5, 6% every few weeks. And some of the factors that you alluded to, fundamental and technical as well, I think are sort of a bit disappointing right now. So I think we need a little patience out here and ride out the next 4 to 6 weeks. Because I think the market's dealing with not just fundamental issues, but a few technical issues. December was not a great month from a flows perspective, where FIIs pulled out about 4,000 crores. And even January has not started on a great note. Now, there could be a whole lot of reasons for that. One could be this global risk-off, which is making investors a little shy of emerging market investing just at this point in time. There could be the China outperformance, which could be weighing on investors putting incremental money to competing markets like India. So that could be one reason. The other could be that we are walking into an earnings season which is not expected to be exactly great out here. So, for various reasons, it's possible that FIIs for the moment have taken their foot off the pedal, and that's leading to a little bit of difficulty on the part of the market to edge higher. Remember, last year was a great year for FII flows, and the market kept on making new highs because at every level there was that cushion of fresh liquidity coming in, which has not been there for the last 5 weeks. So I think there are fundamental issues, there are global issues, which I'm sure we'll talk about, but there are technical issues as well right now, which are preventing the market from going up. Also, the last time we spoke, there was some talk about that Credit Suisse report about how many of the sovereign funds might not be able to pull in as much money into markets like ours because of the way crude has collapsed. And these things are very difficult to prove and certify on a weekly or daily basis. But the fact that the last 5 weeks have been disappointing in terms of flows, coinciding with a complete meltdown in the price of crude, might also add some credence to the kind of talk that was going around a few weeks back.
Udayan, hi, good morning. Happy New Year to you. How worried would you be about this global scare? Is it just noise, you think, or does it have the capability to derail global equity markets, including markets like ours?
Well, the last couple of times, Sonia, we've been scared, but we've not been roiled to a great extent. Every time we've jumped to say this is the big correction and, oh gosh, what's going to happen with global markets? It's just been a routine correction and markets have bounced back. So it's difficult to say whether this time is a bigger correction which is looming because of global factors. Also, this will be manifest over the next few weeks. Between now and the 25th of January, you will hear good news and bad news. Like last night was a bout of not so bad news and markets responded positively. Who knows, 2 days later you will hear something opposite and markets may fall once again. So I think right now in the next 3-4 weeks, till we have some kind of conclusion on the Greek problem, markets might be volatile within a range. Both currencies and stock markets might be volatile. And I think traders might be in a somewhat tight spot at this juncture. On bad days, they will short the market, then the markets will give them a bounce back, and once again, they will be caught on the wrong foot. My sense is that over the next few weeks, you might just see the Nifty in a fairly volatile situation between 7,900 and 8,300. It's only 400 points, but if you're on the wrong side of a 150-point Nifty move, it may make you look quite silly. So this is not a great time for traders to jump in and take big, long or short trades. I think investors might sort of cherry pick if the market goes down a lot, but I think for traders it might be a little too hot to handle the way the volatility is shaping up over the last few days.
Okay, you said that you will need patience to see the market perform from here on. Are you saying that there is definitely no Indian outperformance, at least in the first half?
Well, that depends on a lot of things, Lata, because for India-specific things, you've got a lot of triggers out here which may work in your favor or not. You've got the budget, which I think the market will build up into a big thing, justifiably this time round. You've got the RBI outcomes right after the budget, and I think the market is priming itself for a rate cut. So any kind of dovish commentary and action from the Reserve Bank plus the budget sets India on a course of outperformance relative to the rest of the world. There's no question about that. Those events have to play out along the lines that we are hoping, but there are potential triggers. But having said that, my fear, Lata, is that if FIR flows do not pick up after this kind of weak start to the year that we have seen already, you may struggle for the market to go up dramatically because we don't have the fundamental tailwinds playing in just yet. The market's going up on hope and triggers. It's going up on an election result, on hopes of a good budget, on hopes of rate cuts. But the reality is that the market's getting expensive with every up move, which is why you've seen the last couple of times the Nifty getting stalled around that 8,400, 8,500 level. And I think this earnings season will probably prove once again that the reality will take a little bit more time to catch up. This quarter probably will have another tepid earnings season. And I remember last quarter too, we were disappointed with the earnings season and we were saying earnings need to catch up. But this quarter will probably not be the catch-up quarter once again. So maybe markets will be volatile. We may inch up after a good budget. But I think we need to do a little bit of work out here before the market really takes off in a unidirectional kind of a manner. So I'm not suggesting there's massive downside to this market. Maybe it's only 7,800 and no further. But the upside, I think, will need to be slightly more gradual unless we have a rocket of a budget in February.
So how does a retail investor approach this market now, Udayan? Because, you know, the view that we've got in the last couple of days is that the many macro positives, whether it's the land and coal ordinances, whether it's WPI at zero, all of that will really outweigh the negative global cues. Is that your view as well?
Well, there's nothing wrong or no structural breakdown which one can speak about in the Indian context. Sure, it's taking a bit more time, but there's nothing which has happened right now to suggest that the economic upturn which the market began pricing in a few quarters back has come to an end and there is a U-turn. Some more patience is required, and patience doesn't come easily to the stock market, but I think we'll probably need to wade through a couple of quarters before we get there. But that is not a structural U-turn. So I think the case for India is still fairly strong out here. There's no problem with that. It's just that the market might have priced in quite a bit already and some adjustments might need to be made, which is why I think what happens in the February-March period is very, very important in the relative trade that we are talking about. India has a very good chance of relatively outperforming because a lot of the commodity-heavy markets will underperform because of what's happened with crude. I think the US will face a fairly significant number of challenges as interest rates start going up there during the year. India is in a potentially sweet spot. We just need to play our cards right over the next couple of months and we'll be there. The other thing, Sonia, I think is the choice of sectors. You mentioned investors. I think a little bit of a readjustment of the portfolio may not be a bad idea because I think last year a lot of people played the industrial upturn or the cyclical upturn through some of the capex related plays. And maybe that will take a little longer to play out. Maybe some of the easier trades belong to some other sectors. Also, IT might continue to struggle a little bit because of the global issues which have cropped up. Sectors like metals, energy may not do very well. So, rather than focus just on the Nifty, I think a little bit of realignment of the portfolio to play the next 2 quarters out may not be a bad idea.
I can get to what would you align in favor of? Also separately, the Bank Nifty or the PSU banks, that was the best trade last year.
Well, I think banks still remain a good trade, Lata. If there is massive global volatility, I think private banks will come off. There is no umbilical cord as such, but they generally tend to move in the same direction. You've seen some of the high-quality private sector banks lose ground over the last 2 or 3 sessions. And I think private banks might struggle a little bit. But I do agree with your point that banks remain the place to be putting in incremental money to work if the market comes off very significantly. And that is an area one would like to add. You know, for other sectors, you would need to be a little bit more choosy and careful because one could say autos. But in autos, I think if the market comes off a little bit more to 7,800 levels, you would look to be buying names like Maruti and avoiding names like M&M for the moment. M&M's been an underperformer of late, but I don't think its underperformance has come to an end. If the European volatility continues, you may want to give Tata Motors the skip for the moment. Long term, it still looks great, but for the moment, it may not be a rank outperformer. So even within sectors, you may need to be just a little careful about what you're buying. So buy a few banks, maybe buy a few autos as the market comes off. If you're playing long-term cyclical recovery or industrial recovery, I think some of the names like some of the cement companies actually have not gone anywhere in the last 3 or 4 months. I think there probably is a case for buying into 1 or 2 of them as well. I would avoid names like metals at this point in time with so much volatility. Avoid IT for the moment. Maybe, I know there's a lot of talk about getting into oil and gas names, but the way crude has collapsed, and I don't see $90 back in a hurry, there might be trading opportunities in names like ONGC, but I would still stay clear of oil and gas for the moment because there might be just too much volatility for the lay investor.